Building a growth ETF portfolio. After 40, a complete beginner roadmap. If you are over 40 and you feel like you started investing late, then this script is for you. You are not behind. You are early compared to most people who never start at all. Stick with me for the next few minutes, because by the end, you will understand exactly how to choose a growth-focused exchange, traded fund, without gambling your future on hype. Most beginners make the same mistake. They pick an investment because a stranger online told them it was hot. That is not a strategy. That is luck. And luck runs out. What you need instead is a simple, repeatable checklist that you can use for the rest of your life. The first thing to look at is direction. Has this fund been climbing over the past year? Has it been climbing over the past 5 years? Has it been climbing over the past decade? If the answer is yes across all 3 timeframes, then you are looking at something with real staying power. If a fund has been sliding for years, that is a warning sign, no matter how exciting the pitch sounds. Momentum matters, and history tends to repeat more often than people expect. Now, here is something most people skip, and it might be the most important part of this entire video, so do not look away. The second filter is average yearly growth. A broad market fund typically returns somewhere around 7 to 10% a year over long stretches. If you want faster growth from a tech-heavy fund, you should be aiming higher than that. Look for funds that have historically delivered somewhere in the range of 12 to 20% annually. That extra growth is the whole reason you are stepping away from a plain index fund in the first place. Third on the list is cost. Every fund charges a small fee every year called an expense ratio. This fee gets pulled quietly from your returns, whether the market goes up or down. A reasonable target is anything under 0.5%. Some of the best growth funds charge far less than that. Paying attention to fees might sound boring, but over 20 or 30 years, even a small difference in cost can turn into tens of thousands of dollars. Do not skip this step just because it feels tedious. Fourth is dividend yield, and this one surprises a lot of new investors. Growth funds usually pay very small dividends, and that is actually a good sign. It means the companies inside the fund are taking their profits and reinvesting them into research and expansion, instead of handing cash back to shareholders. You are trading a small yearly payout for the chance at bigger long-term growth. Fifth, and this one is critical for anyone in their 40s or 50s. Stay away from speculative junk. No penny stocks. No meme-driven hype baskets. No brand new companies with zero profits chasing a trend. You are past the point in life where wiping out your savings on a gamble makes sense. You have responsibilities, maybe kids, maybe aging parents, maybe a retirement date that is closer than it used to be. This is the season of your life to be smart, not reckless. Now let me show you how this actually plays out in the real world, because theory only gets you so far. Picture 2 different funds that both hold the same handful of massive technology companies: chip makers, phone makers, cloud computing giants, search engine giants. The companies overlap almost completely between many popular growth funds. What actually separates one fund from another is the weighting. One fund might put 14% of your money into a single chip company, while another fund only puts 8% into that same company and spreads the rest more evenly. Neither approach is wrong. It just depends on how much confidence you have in any one company dominating the future. If you believe strongly in artificial intelligence hardware, then a fund with heavier weighting toward chip makers might suit you. If you would rather spread your bets more evenly across several giants, a more balanced fund might let you sleep better at night. Still with me? Good, because this next part is where most beginners get stuck, and I don't want that to happen to you. Price per share confuses a lot of new investors, and it should not. A fund trading at $30 a share is not automatically cheaper or better, than a fund trading at $700 a share. What matters is the percentage return, not the sticker price. Many brokerages today also let you buy fractional shares, which means you can invest any dollar amount you want, regardless of the listed share price. Do not let a big number scare you away from a fund that otherwise fits your goals. Let's talk about the honest trade-offs, because I promised you real talk, and not a sales pitch. The upside of growth and tech-focused funds is obvious. Historically, they have outpaced broad market funds, and they have absolutely crushed slow-moving dividend funds over long stretches of time. But upside always comes with a matching downside. These funds swing harder in both directions. When technology stocks rally, these funds shine. When technology stocks correct, these funds can drop faster and further than a broad market fund would. That volatility is the price of admission for higher potential growth. If watching your account balance swing keeps you up at night, then you may want to balance a growth fund with something steadier as part of a wider portfolio. There is no single right answer here. There is only the right answer for your personal comfort level and your timeline. One more thing before we wrap this up, because I think it is the most overlooked piece of advice in the entire investing world. Do not chase performance. Do not jump from fund to fund every time you see a headline about the latest hot pick. Pick a strategy that fits your goals. Apply the 5-point checklist we just walked through. Choose 1 or 2 funds that match your risk comfort. Then leave it alone and let time and compounding do the heavy lifting. Wealth building is not about finding a secret. It is about consistency applied over years and decades. You are not too late. 40 is still early enough to build something substantial if you start today and stay disciplined. Take what you learned in this video. Pull up a brokerage account. Search for a few growth-focused funds. Run them through the same 5 checks we covered here. Direction, growth rate, cost, dividend behavior, quality of holdings. Do that homework once, and you will have a framework you can use for the rest of your investing life.